All right. So last time when we were together, last week Thursday, we started accounting for treasury stock, and we spoke about how treasury stock is stock that the company has bought back, right, from investors and actually gave them money. Remember, we clarified that they're not just taking back the stock without giving people money, but they're paying them the market price of the stock on that date, and they're buying it back for any number of reasons, including, thinking that the stock price is undervalued, wanting to push up the price, wanting to prevent some type of takeover or purchase of the company by some outside party. So they're holding some of the stock. I also told you, about how the airline companies did so much stock buyback before the pandemic, and then when the pandemic hit, they did not have enough money to really make it through. I think it was even 2 or 3 months. The government had to bail them out. You see a similar story in your textbook about Reebok that was doing stock buybacks, and that they ended up having not a lot of cash on hand to make themselves a less attractive acquisition targets, right? They didn't want to be bought by another company. So we found out that the treasury stock then is held by the company. It's not retired, which means that when the company buys a stock, they can actually reissue it at some future date if they want to. At whatever price they choose to do at that point. But in the meantime, it's being held in the treasury, which means it's being held by the company itself, which means it doesn't have any voting rights. Like the company, the shareholders vote on all kinds of stuff at the annual general meeting. But just because the company is holding the stock doesn't mean it can suddenly also vote. Someone from the company can now vote about different decision making. It doesn't work that way. It also can't receive any dividends, and we'll talk about dividends later on in chapter 14. And so we said when we purchase treasury stock, we use what's called the cost method. In other words, we record the transaction at the amount that it actually costs the company to buy the stock, not at par value. So this is, where things might become a little bit confusing, because when we were doing the issuance of common stock, we focused a lot on whether there was a par value or no par value, and we used that number to credit common stock. Yeah, you have to be careful. Sometimes the questions tell you what the par value of the stock is that's being bought back, but that's not the number that you focus on. You focus on the actual cost of the stock. Now, if the cost of the stock is the same as par value, obviously that's fine, but you still are looking for a cost number. So under the cost method, the company debits the treasury stock account, and we said that the treasury stock account is a contra stockholders equity account. So it's stockholders equity, but it increases on the debit side because it's going to be a subtraction from stockholders equity. It's almost like how accumulated depreciation is subtracted from the asset balance, right? That's a contra asset, but it's the same idea. So we don't debit common stock because we bought back the stock, right? Because we have to keep that common stock number intact. Whatever we have to show what we raised in the past by issuing the stock. And so we create this treasury stock account that we debit. So it goes up on the debit side and down on the credit side. And when a company does have treasury stock, it has to show the number of shares that are in the treasury so that the users will know how many shares are actually held by the company itself, and then also the dollar amount that is in treasury stock. And I'll come back now to example 12 in a minute. I just want to talk through the sale of treasury stock. So when the company decides that, okay, we've had the stock in the treasury for a while, we want to look at reissuing it to the public, sending it back outside of the company. Sorry, there's such a lot of noise. I'm sure you can't hear anything, but I'm just waiting for the noise to pass by here. So the sale of the treasury stock is kind of just the opposite. When we buy the treasury stock, we debit the treasury stock account. When we sell the treasury stock or reissue it, we credit. Right, we credit the treasury stock account with the same amount that we paid to buy the shares. So it goes in at cost into treasury stock at cost, and it comes out of treasury stock at cost. And then we also will debit cash at this point because we receive cash from the stockholders. Sorry, there's I don't know if there's an accident or something, but there's an immense amount of noise where I am. So I'm just going to wait for it to pass. In fact, I'm going to close the window for a second. And the joys of living in New York. So when we buy the treasury stock, we debit the account at cost. When we sell the treasury stock, we credit the account also at cost, and cash will get debited because we'll receive cash from whomever we sell the treasury stock to. And we can sell the treasury stock at or above cost and even below cost. We're only going to look at sales at or above cost. We're not going to look at selling the treasury stock below cost. That's outside the scope of our work. Okay, so yeah, I'm giving you the journal entries. When we sell at cost, we debit cash and we credit treasury stock. When we sell so it's just an in and an out. There's no profit, right, that we're making on selling the treasury stock. When we sell, that's for at cost. When we sell above cost, we make some extra money. So we debit cash, we credit treasury stock. Any remaining amount, right, the excess is not going to go to net income or something like that. It's going to go to the same type of kind of paid in capital, but there's no in excess of par or whatever, because we're not working with par. It's just crediting an account called paid in capital from treasury stock. So if you're working through the treasury stock examples and stuff, you can basically follow. I mean, all these things that I'm saying are also written in the
Good morning,
textbook.
Professor.
Good morning. All these things that are written here are also in the textbook, but this is kind of just a summary of how to do this. So we are looking at example 12. We did this last time. We kind of finished up. Let me just go down here. We kind of finished up on example 12. I'll just run through what happened there, and then we'll move into something else. So on example 12, we said on February the 1st, 2018, Mead Inc. acquires 4,000 shares of its $8 shares of its stock at $8 per share. So the reading of the question of its stock tells you that this is a treasury stock transaction. $8 is the cost, and so we said 8 times 4,000 shares is 32,000. So just like we read a minute ago, debit treasury stock, it's going up by the number of shares times the cost per share, and we credit cash because we're paying the money to whomever we are buying the shares back from. So that's the purchase. And then over here, it's asking us to prepare a balance sheet. So I'll prepare a balance sheet for you so that you can see how treasury stock is, treated as a deduction from the stockholders' equity balance in the balance sheet. And so it says, assume that the stockholders' equity section of Mead Inc.'s balance sheet contains 100,000 shares of $5 par value common stock outstanding. Okay, so this is what will be in the common stock account balance. And so it's not the 100,000 shares, it's not just $5. You have to basically multiply this out. So what they're trying to tell us is that the common stock balance, remember it's the number of shares times the par value, the common stock balance on the balance sheet is going to be $500,000. And retained earnings, and the stock was issued at par value, which means that there's no paid in capital in excess of par value account. All right, so all of this, it's just one simple, right, quote unquote sentence, but it's actually giving you a lot of information on how to build the balance sheet. You have to multiply out these two numbers to get to the common stock balance. You have to realize that there's no additional paid in capital because it tells you that the stock was issued at par value, so everything went into common stock. And then you have your retained earnings number that you're going to have to show in the stockholders equity section as well. Prepare the stockholders equity section of Mead Inc.'s balance sheet before and after the purchase of treasury stock. I'm not going to do before because we've done that like many times now, probably at least 3 or 4 times, and that's going to be, people are going to be zoning out here. I'm just going to do the after one. that shows how to treat treasury stock, because I think that's really where our work is going to lie over here. Okay, so stockholders equity section. So it's financial statements, right? So we're going to start with the name of the company. There's going to be balance sheet, and you can put partial, or it depends on the question. They may already have this information in there. I know that this is not really the date, but I'm just going to put December 31, 2018. I believe the date was actually earlier in the year, but doesn't matter. We just assume that we're doing this for the annual balance sheet. Now you've got again, you don't have to put liabilities and stockholders equity. I think in Wiley, they start at stockholders equity, or if you've already done the last question of the homework, you see that they actually just started paid in capital. Someone's looking for me in the chat. Sorry, so just hold on. But until now, we worked with companies that were selling stocks and we created common stock. So what is the difference now that we created treasury stock? Yeah, so see, you're asking me why we're crediting treasury stock when we sell the treasury stock, because the treasury stock doesn't exist anymore. So we have to decrease the account balance. Okay, it's not I'll show you when we do the balance sheet that it all works out in the end. But basically the credit to the treasury stock is not so much because you're reissuing the shares, so it's like another issuance of shares. It's got more to do with the fact that the treasury stock balance increased on the debit side when you bought the shares, and so now it has to decrease on the credit side when you sell the shares. And we can talk more about that as I build this balance sheet, because I think building the balance sheet is going to show you the treatment of the treasury stock even more. So we've got stockholders, where am I? We've got stockholders equity, right? And I know it gets repetitive, but normally the balance sheet is a part of this chapter that people really struggle with, because there's so many names and subheadings and headings and stuff. So I'm trying to do it as often as possible so you can become more comfortable with it. Stockholders equity, the next heading is paid in capital, showing all the capital that is coming from outside, and then it's capital stock, right? So this is for preferred stock and common stock, as opposed to the additional paid in capital, which is the excess. So now you've got common stock, right? And I know that when you do the questions in Wiley, they don't ask you to do this, but I'm going to write this out so that you can see how the treasury stock actually impacts the number of shares outstanding. So we know that it's common stock. I'm going to write that it's $5 par value, right? 100,000 shares were issued. And because we bought back 4,000, only 96,000 are outstanding. Okay, so where does this come from? You go back to the question, you see that 4,000 shares are in the treasury. So if 100,000 shares were outstanding, but now we bought back 4,000, it means that only 96,000 are outside, held by people outside of the company, because the other 4,000 is held inside the company. All right, so you'll see this in the textbook also. That's what this means. So here we are going to say the 100,000 shares times $5 per share, right? Which is 500,000. That's what they told us in the question, is the amount for common stock. Now you should have a problem with that, because you're going to say, but there's only 96,000 shares outstanding. Why are you using 100,000, right? And 5, because over here you show everything that was ever issued, even if some of it was bought back. And later on, when we show the treasury stock, we'll show the 4,000 shares that were bought back from investors. So note again, when we prepare a balance sheet that does include treasury stock, the common stock number is always going to be the total number of shares that were ever issued multiplied by the par value. If there's a par value, you don't reduce the common stock for things that were bought back. You'll show that separately in treasury stock. The outstanding, you're asking what is outstanding? Think of outstanding as being held outside of the company. So normally without the treasury stock work, you just have 100,000 shares issued to the public, and 100,000 shares are also outstanding, being held outside of the company, right, by the public. But now, because 4,000 shares are being held by the company, only 96,000 is outstanding. So we did issue 100,000 shares, but 96,000 are outside the company and held by, any number of individuals, and 4,000 are inside the company. That's what outstanding means. And so we don't have a preferred stock, so we can do, a subtotal over here. So this is total capital stock. It's, nothing outrageous. It's just the 500,000. And then we move into immediately, basically, we move into retained earnings, because there's no additional paid in capital, because they said that the common stock was issued at par. So it's going to be 200,000 in your, I'm just skipping a line here, just so that everything's not on top of each other. Right, 200,000 is my retained earnings. So under normal circumstances, if there was no treasury stock over here, we just call this total stockholders equity and be done, right? But because there's treasury stock, we have to say that this is total paid in capital and retained earnings. So basically, you're just saying that this is the total of the two things that you just, calculated. So it's the 500,000 plus the 200,000 is 700,000. I see a question in the chat. Let me check. So the company does not own. No, the outstanding is owned by people outside of the company. Yes. So if we're investors in Facebook, and yesterday was a very interesting day. I thought for sure that I was addicted to Facebook, but realized I'm probably not that addicted if I didn't even realize that Facebook was not online until I saw a news headline. But like yesterday, the price went down quite a bit because of this massive outage and whatnot. If you look at this market capitalization, all right, it's almost $1 trillion. It's 939 billion. So see, you're asking what is outstanding, what is outside. This is the number of shares that were issued times the price of the shares, not par value, but just the actual price of the shares right now. This is what's owned outside of the company. Facebook doesn't have treasury stock, but I guess I'm just trying to show you that whatever is being quoted over here and whatever is being shown, that is what is outside of the company. Anything that the company is holding inside is not going to form part of this outstanding. So I would focus on these first three letters, O-U-T, out. It's outside of the company, whereas treasury is inside of the company. So we total up the paid in capital and retained earnings, and then we have to subtract the treasury stock. So this question, this is like a B part of this question, okay? So I'm going to pull the number from here. So the treasury stock is 32,000, and what we write over here, so that people can know how many shares are being held by the company, you write that it's 4,000 shares, okay? Or it could even say 4,000 common stock or something like that. So this 4,000 shares and this 96,000 together make up the 100,000 that was originally issued, right? That 100,000 is now split. And I mean, I've said this now probably 5 times, so hopefully it's sticking. That 100,000 is now split between the 96,000 that is held outside of the company and the 4,000 that is held inside the company. And so the 32,000 is a less, right? It's a subtraction. So please be careful when you're doing these calculations that you actually do subtract it. And so in order to get to our final number, which is total stockholders equity, we are going to say, trying to move too fast, sorry. We are going to say 700,000 minus the 32,000. So our total stockholders equity is 668,000. If we had no treasury stock, it would have been 700,000. But because we bought back some of the shares, right? Only 668,000 belongs to people outside, and the other 32,000 is what is being held inside. Yeah. So yes, Zuckerberg lost almost 6 billion in the dip because yesterday, I mean, just as an aside, like for a 30-second aside, yesterday, first there was the woman who identified herself as the whistleblower who leaked the pages about how to some extent it benefits Facebook from a revenue perspective if people spend more time on on the platform, and the ways in which people often spend more time is if they are consuming media that is making them angry, because then they then I guess they're arguing and going crazy. So that's actually a good thing for the company, not necessarily for our own mental health. So so that story broke, and so that was already not good, because I own some Facebook shares, so I got a notice. I think that Facebook was like down by 5% or something, and then next minute there was this outage on Instagram, WhatsApp, and Facebook. They're all part of the same family, and yeah, Zuckerberg lost a whole heap of money. It's just interesting though with these billionaires that it's almost like, I mean, what is 6 billion really when you're worth like 90 something billion or whatever? It's almost not like truly conceivable. These people are so rich that it's like I don't want to say that it's a rounding error. I mean, 6 billion is still 6 billion, but there's just something about this immense wealth that, if someone said like, I lost, 6 billion, I would be shattered. I mean, I don't even have, a million, but for them, it just doesn't seem like, I don't know, maybe he's crying today. I don't know.
That's like pocket change to him.
Yeah, right. Yeah. Yeah, a lot of people, Michelle, thought that there was something wrong with their phones. It was, I feel like, and the 30-second aside is going further, but this is life, so we talk about it a little bit. I feel like it was actually for some of my friends who were remarking, and maybe, I mean, we're in an older age bracket, I guess, than some. I'm 41, so you can gauge where you are in your age in relation to me. But it was almost like a reckoning to say, how addicted are you really if this thing is down for so many hours and you feel like, oh my word, I've got to keep refreshing, like what's happening? I can't believe this. I need to check Instagram and so on. I just feel like it's if we reflect back on what happened, it's just interesting from a personal perspective to think about how we spend our time, and what was life like before social media, and what does it mean to truly be engaged in what you're doing, to be immersed in something which like if you're doing something and not distracted. And social media has its place. I'm like many of you, I'm also an immigrant, so it really helps me to be on the channels, because I can still connect with people from Cape Town and so on, where I'm from. But there's also an element of of distraction, which means that when I'm doing something, sometimes I'm not really fully engaged in anything, because I'm jumping between what I'm doing and the social media channels. And so it actually, and I'm becoming too philosophical now, but it actually begins to impact our quality of life, because I was reading an article that said, and I mean, it's scientific studies about how much dopamine is released into our brains when we're looking at all the social media and so on, and how addictive it is. And it's true. I mean, there's no shame in it. It's true. We're all, or not, I shouldn't speak for everyone, but I know I'm also, part of that. But yeah, it's unplugging and unwinding and going back to basics. Well, Sam says is bored by it, so that's good. That means that you don't have to stay on it. It's just interesting to see how far we've come. I guess I'm a child of the 80s, so I can still remember when none of the stuff existed, and there was an element of a less complicated way of living when I wasn't constantly checking to see what everybody else was doing. But then there's also all these support groups and things that have really enhanced our lives. So I don't know, It was just a great experiment yesterday to see how people cope without these things. And I don't know how Zuckerberg will cope without these 6 billion, but something tells me that he'll be okay, right? Because if he didn't sell his stocks yesterday, which he shouldn't, with such a massive drop, he's back up again. He's back up again today, right? So, and he will probably keep going up. Yes, it's a pretty low, like a $20 dip, but it's gonna come back. I mean, the market generally comes back, so he'll be fine. Anything else that anybody wants to say about that? Are you guys all okay? You didn't experience extreme.
I was
Um,
bored. I was at work. I thought my phone was acting up. I called my company and was just like, yo, I don't think my internet is working.
Yeah, yeah, totally. Someone was saying like they got into one of my friends, they got into a fight with their partner because they're like, did you turn off the internet on purpose? And I mean, there probably were quite a few like desperate calls to various places to say, hey, what's up? So yeah, now we know these things are possible. It's possible for the system to crash. From a business perspective, it's very interesting. They're obviously being very closed mouth about what actually happened, but from a risk perspective, if you think about the auditors going in there and what the controls were that didn't work, for either if it's a bad actor, I don't know who did this, if it was a hack, if it was just a system failure. That's something pretty significant to think about from a business perspective. Like, how do you prevent something like that from happening? Maybe it was just a massive DNS attack. I don't know. I don't know that they will ever tell us, because that would be showing the chink in the armor of Facebook. But it's as business people, it's interesting to think about what could have been the source of such a massive outage. All right. Well, back to non-exciting Facebook discussions. Example 13, I'd like you guys to try on your own. It shouldn't really take that long. It's Drake. I'll read it with you, and then you try to do it. It's just purchase of treasury stock, right? That's the journal entry that you're going to be making. Drake Inc. purchases 3,000 shares of its, remember, so when I say of its stock, it's treasury stock, of its $50 par value common stock. And here's the price. This is the cost for 210,000 cash. Notice that they don't give you a price per share. They just gave you the total price that was paid on July the 1st. It will hold the shares in the treasury until resold. So this is the second time that they're kind of telling you that this is treasury stock. Prepare the journal entry for the purchase of the treasury stock. So I'll give you until 11:20, which is more than enough time to finish the journal entry, and then someone can raise their hand. Maybe someone who hasn't spoken much today can raise their hand and let us know what the journal entry is.
Professor, we're doing example 13, right?
Example 13. Yeah,
Okay, just making
Yeah.
sure.
no problem. Can we get, I see your hand, but I'm trying to see if I can get someone who hasn't had a chance to really talk much today to give me the answer to this. Can I get another volunteer other than C? Please.
I can try.
Yeah, who's speaking?
Jahome.
Okay, Jeremy, great. Thank you. Let me just get my act together here and get into the mode of doing the journal entry.
Okay.
Okay, so what do you want to tell me?
Okay, so I guess we can put in the date.
Mm-hmm.
I
I
put
believe it
July,
was 7/1. Mm-hmm.
yeah, 7/1.
Mm-hmm.
And then we can put the what he invested. I don't know what I would title it. I guess, well, we could put
Remember,
stock, right?
yeah, so exactly. So what topic are we busy with? Treasury stock, right?
Would it be
So that's
Treasury
your,
stock.
yeah,
Yes. So
yep,
we'll do
yep, yep.
treasury
I'm sorry.
stock. It's okay.
Yes.
And then we'll do it
What's your amount?
for it's 20, it was 210,000.
210,000. And what are you gonna
Yes.
credit for me?
I am going to credit the same thing, 10,000 because we're
Yes.
holding it.
Dollar amount, yes, but what account are you gonna credit? Sorry.
Oh, we're gonna cash
Yes,
because
perfect.
he
Mhm.
invested. Yes.
Yeah, the company purchased treasury stock. Thank you. This
Yes.
is correct. So debit treasury stock with the cost of the stock 210,000 and credit cash 210,000. Yes.
Yes.
Thank you. Now,
Mhm.
I just, for those who maybe got confused here, because remember, we've got some extra information that we don't actually need. I'm just going to flip quickly back to the
Which
question.
is
I'll come
the
back to the
right.
solution.
It was the $50
Yeah, yeah.
part, right?
So don't get confused exactly with the $50. This is what I was saying before about the cost method. It ignores any par value that may exist. So you can't say 3,000 shares times $50, right? For whatever it is, $150,000 of treasury stock, because if we go and look back at the theory that tells us how to calculate this, right? You debit treasury stock for the price paid to buy the shares, not par value, the actual price that's paid. That's why Jahome's answer was correct, because she went with the 210,000 cash that was actually paid to purchase the shares. Okay, so if you put 3,000 times 50, 150,000, that's not right, because par value doesn't factor into the calculations for treasury stock. You focus on the cost of what was purchased and not the par value. Any other questions here or anything that is not clear?
Professor, I just wanted to know, say this is a homework. If I had to add the 3,000 shares that were purchased, do I enter that into the entry anywhere at all? No,
No,
right?
remember, you
Okay.
only journalize dollar amounts. You can't journalize, the number of shares, and then the 3,000 with the 50, maybe if you thought that you had to put that in, doesn't belong here. You are
Okay.
right. You're just completely focusing for treasury stock. Okay, so it gets confusing because when we're doing the issuance of common stock, you absolutely have to focus on par value as well. But treasury
Okay,
stock is
got
a
it.
treasury stock. So the stuff we did earlier, I just want to be sure that we're not messing this up. All these things from before, par value is definitely a factor. It needs to be looked at. But there's the potential for massive amounts of confusion, because when you get to treasury stock, you are ignoring par value and using, cost. But that's just for that topic. Okay, it's a whole separate exercise.
Got it. Just
Mhm.
for treasury stock, right? Okay.
Yes, because the
I
company is
will
buying back
highlight
the
that.
stock. Yeah, the company is buying back the stock. With the other stuff with common stock that we're doing before, the company was issuing the stock, it was selling the stock, and then you definitely look at par value or no par value, or no par value with a stated value. All right, treasury stock, forget about par values. Other questions, guys? All right. So let me do example 14 with you, and then we'll take a break. This is moving in now into the sale of the treasury stock, right? So, with hopefully not beating a dead horse here, but if we think about the sale of the treasury stock, it's what I was just talking about before. The sale of the treasury stock can be at cost or above cost. That's what we're going to be focusing on. This is literally the journal entry, okay? When we sell the treasury stock at cost, you debit cash and you credit treasury stock with the amount that you received for the sale of the treasury stock. When you sell it above cost, you debit cash for the amount that you received, you credit treasury stock for the cost of that treasury stock, and then if there's any excess, you credit paid in capital from treasury stock. We'll do examples, but I just want to show you that, if you refer to the class notes, remember all this stuff is available under Zoom meeting materials, the class notes, the book, wherever. You have to know the theory behind this to be able to do the journal entries. None of this is like what we would say intuitive, like it's just going to come to you naturally, out of the air. You have to actually study it. You have to study the names of the accounts and so on. Often people struggle with journal entries because they don't know which account names to use. So if we just do a sale of treasury stock above cost, right? This is above cost here quickly. So on July the 1st, Mead Inc. sells for $10 per share. So that's the selling price now. So they're reissuing the treasury stock. They bought it earlier. Now they're selling it back for whatever reason. Maybe they need cash, right? They sell for $10 per share, 1,000 shares of treasury stock previously acquired, so previously bought at $8 per share. So the $8 was the original cost of this treasury stock. They're now selling it back to the public at $10 per share, and we are being asked to journalize the sale of the treasury stock. So again, when we look at our notes, we see, a sale above cost, we have to debit cash, we have to credit treasury stock, and with any excess, credit the paid in capital from treasury stock. So I'm going to do that quickly, and then we'll do a break after this. So again, this is the sale now of treasury stock that was previously purchased. So it's still July the 1st, supposedly. You are receiving cash because you sold the stock. So $1,000 shares, times $10. That's the amount of cash that you're receiving. So it's the number of shares times the selling price. Okay, so 1,000 shares times 10 is $10,000. All right. And then when we bought the treasury stock, it went up on the debit side. When we sell the treasury stock, we're basically getting rid of it. So we're crediting it. Remember, it's a contra stockholders equity. So it's going to go down on the credit side. So treasury stock is going to go down, but here's the formula. It's going to go down by the number of shares multiplied by the original cost. So if we think about what's the original cost, it's given to you in the question, it was $8 per share. So you're not doing the $10. You have the treasury stock cost you $8 when you bought it.
It's gonna be 8,000?
It's going to be eight. Thank you, whoever said that. Now you can, thanks. Now you can see that there's a mismatch. Dollar amounts of debits and credits are not equal. You're hanging, right? There's 2,000 hanging that doesn't have a home. And that's where this note came in, that the excess is going to go to paid in capital from treasury stock, because this is extra money that the stockholders, that belongs to the stockholders, but we don't want to call it in excess of par or whatever, because remember, we're not working with par value with treasury stock. Also, we want to differentiate it to say this extra paid in capital basically came from a different place. It didn't come from common stock or preferred stock. It came from treasury stock. So this is a sale of treasury stock above cost, because cost was 8, selling price is 10, so we sold the treasury stock for more than what we bought it for. Questions on this one? All right, so we will break here until 11:40. When we come back, you guys can practice example 15, then we'll move into preferred stock, which will be a very quick thing. Okay, so 11:40, we resume. I'll stop the recording now. Oh no. Okay, well, sorry to anybody who's watching the recording. We missed everything from the break, I think. I didn't realize I wasn't recording. That's brutal. Okay.
It's okay. We're able to see the answers on the
Yeah,
when we pull it up. I know.
that's why I never want to pause. I pause the recording when I gave people some time to do, because I normally don't want to pause it because I don't trust myself to remember, and I've proven that I shouldn't trust myself. But thank you for making me feel a little bit better. All right. I'm just checking that I've got everybody's attendance. I mean, recording this now is kind of a little bit of work. All right, so for chapter 14, it's still corporations, but we're going to be focusing on dividends much deeper, on retained earnings, and then also on the income statement. Yeah, in the opening, they talk a little bit about employees that have a stock plan, the company's giving them a stock plan, and how they, to some extent, I guess the employees didn't truly understand the value of what they were getting when they were getting stocks instead of just getting cash. And why that's part of the discussion is there is such a thing as stock dividends, where a company is going to issue a dividend as stock, and you may be like super excited about that right now, but it actually isn't something that we cover in depth in our class. What we're actually focusing on is dividends that are paid out in cash. All right, sorry, this book can be marked up, so every time I highlight something, it wants to give me an option to mark it up. So we'll be focusing on cash dividends. We'll also talk a little bit about stock splits in this chapter. And then we'll go back to, we discussed a little bit what retained earnings is, all the profits that are kept in the business and not paid out. But we'll spend some more time there seeing how to calculate the retained earnings balance and making sure we understand what increases and decreases retained earnings. And then we will revisit the income statement. The difference here with the income statement is that the companies are going to have income tax expense, right? Versus, sole proprietorships and partnerships, it was the owners that get taxed in their personal capacity. But with companies, it's the company that gets taxed. So really the income statement is kind of the same thing as the multi-step income statement that you had before, sales less cost of goods sold is gross profit, less operating expenses is, at that point you would say, net income, but you're going to say income before, income tax expense, and then deduct that expense from your income to get to net income. So that's really the crux of what we will be doing in the chapter. I did upload for you guys already. This was already up last week, all the notes, all the exercises, any tips and tricks, because there's a few things that are a little bit hard in this chapter. Specifically, people struggle with that split between preferred stock and common stock, which I was talking about earlier when I forgot to record anything. And then I'll go over that again, and then all the solutions for the classwork that we will be doing. So I'm gonna just say that when we pick up on Thursday, we'll immediately start talking about what is a dividend and some important dates related to dividends, and then we'll go into journal entries around cash dividends, all right, and then the split between preferred and common stock dividends. So that's it in terms of a primer for chapter 14. Again, don't worry too much about where we are right now. If you look at our calendar, we're actually still due to continue with chapter 13 on Thursday. We won't do that. I'll go on with chapter 14, but on the 14th of October, after you've done the chapter 13 homework, I'll go over the homework in one of our class sessions, so that will take up some time. So, you know, the time will work itself out. Just remember, today, in a week's time, your chapter 13 homework is due. You have everything you need now that we finish the chapter to be able to do the homework. Please do not procrastinate and leave it till the last minute. It's a lot of work in the homework and it's easy to get confused. So you need to be able to still ask me questions. All right. So you guys are dismissed. I'll stick around here until 12:45 you know, in case someone needs me. And then I've also got office hours at 1 o'clock today if anybody needs help with anything. All right, I'm here. Ask me any questions. And if not, go and have a lovely day despite the gloom and the rain. Hope you have a good day.
Professor, what
Yes.
do you read for next class?
Okay, so let's look at
Thank you, Professor. Have a good day.
you too. Just hold on a
Thanks,
second.
Professor. Have a good one.
You're welcome.